Welcome back to the Panther Business Briefing. I'm your host, Jayson Reed, and I'm joined here by my co-host, Baran Pourtahmaseb-Sasi. Now, for this fourth episode, we'll be transitioning from our theme of oil and gas to an entirely new focus that's on residential housing in the United States. Last week, we sat down with FIU's College of Business Dean, Dr. Hardin, who did a phenomenal breakdown of today's residential real estate market. We start off the show with our introduction for him, along with Baran's excellent question about post-COVID housing trends. Here it is.
Ladies and gentlemen, it's my pleasure to introduce our esteemed guest today, Dr. William G. Hardin III. Dr. Hardin is currently the Dean of Florida International University's College of Business and a distinguished figure in real estate and finance. With a PhD in real estate from Georgia State University, he got his IMBA at the University of South Carolina. Now, he's made significant contributions to research on real estate investment trusts, corporate governance, and real estate market analysis. In addition to his academic and research accomplishments, he's actively involved in professional organizations such as the American Real Estate Society, the Urban Land Institute, and is a fellow of the Royal Institution of Chartered Surveyors. Dr. Hardin, thank you for joining us today. Is there anything more you'd like to add?
No, that's perfect. Thank you. I didn't know I had that many accolades, so thank you.
So the COVID-19 pandemic, we saw that there was some sort of impact on the housing market in general. Would you be able to go into what your observations were and also what were key takeaways in terms of home ownership, how the market and the industry was incentivizing home ownership financing, maybe how we could see that in the future? These migrations of workers moving from different parts of the country can come into key real estate areas, let's say?
So if we look at COVID, we have multiple things happening at the same time. You had the pandemic, COVID pandemic. You also had unprecedented low cost of money. Okay, and part of that was to stimulate the economy. Post-COVID, we closed down. How do you stimulate things? You basically pump money into the system, which is what the Fed did. So if you remember back in 2021, 2022, you could get a 30-year mortgage that's at 2.4%.
Right.
So you had kind of a financing component to it, and then you also had what I would say kind of the opportunity set once people determined that it was viable to work from home, that they could make choices, that they could live in a different area, that many of the jobs that we have, especially at the higher end of the income and wealth continuum, were really somewhat placeless. We always talk about location and place, and that still matters, but what we figured out, if you're a high-end Google engineer, if you're a high-end finance person, you may or may not need to be located in a certain area because you have instantaneous access via the internet, via Zoom, via technology. And so you had these confluence of these two things that allowed the market and people in the market to change their living patterns. There's a professor out at Stanford, Nick Bloom, who does a lot of research on work from home. And what you're finding is you can work from home in a lot of professions. And so then it comes down to, if you can work from home, where do you want to live? And can you live in a place that's less expensive and take that income with you? So that was the kind of the first part, which is I made X amount of money. I can take my income with me, and I can go to Sarasota, or I can go to Broward County, or I can go to Florida, and I can basically acquire a property with low interest rate and live pretty well. So for me, when I think of the pandemic, I think of those two things. And I think what happens was, if you look at Florida, for example, we had tremendous net migration out of the Northeast. That was driven in large part by a subgroup of people who could work most anywhere, and there was a natural affinity between especially South Florida and the New York and D.C. markets.
Right.
So people were going, no state income tax, no problem getting from one location to the other. There's a flight every hour that goes from Miami to New York. The cost is relatively low at the time, and that's why we've seen prices in Miami especially on the high end, accelerate because it was simply to me, a wealth transfer or the ability of the wealthy and affluent to move to Florida and still work whatever they were doing. Because many of these jobs or positions, they traveled all the time anyway, which is if I'm going to travel 2 or 3 days out of the week, what's the difference between Miami, Chicago, New York? Because I'm not place bound anyway. So Miami and Florida was a huge beneficiary, South Florida especially from Palm Beach on down, of people who have flexibility. I actually have taught a webinar, or not a webinar, a seminar that we do with our EMBA consortium group all about wealth aggregation and how we have created a world where wealth is no longer location bound. So I can run a business in Latin America from Miami.
Right.
The technology exists. I can get every operating data every day. I can be on Zoom. I can have technology, and I can live in Miami or I can live in Sao Paulo. I'm not place bound.
It's interesting that you mentioned technology playing a role, especially in how it changes the workforce culture and therefore like you mentioned, pattern of life changing decisions. So maybe one of the things you could touch on is the role technology and data-driven consumer behavior has kind of changed the way the real estate market and industry has been engaged from the consumer side as well as from the financing side. Like, for example, we have these platforms like Robinhood or Webull for day trading purposes, or Fundrise and Roofstock, which are more along the lines of helping the real estate markets.
Right.
How has this helped shape further this lifestyle change?
Well, I think there's a lifestyle, and then there's an investment component to it as well, which is real estate is tangible at the end of the day. So you have crowdsourcing. There are a number of providers of that, and they can sit down there and say, you're going to buy, and some of this is tokenized, some of it, there are various different ownership structures that come in there, but it's simply going, if you own this property, here's what it is, here's what it's doing. And it's a relatively easy investment for someone to understand. I buy this and it generates a cash flow, and I get X% of that cash flow. Okay, I'm not betting on technology. I'm not betting, not betting on this is the greatest, newest chip that's going to put NVIDIA out of business. It is simply a relatively straightforward proposition. So that's appealing to a lot of residential-oriented investors.
Suitability is obvious, right?
Yeah, I mean, and it comes out of also an entrepreneurial business, because there are many people who own 2 or 3 rental properties, or 3 or 4. And now, of course, we have Invitation Homes, we have some real estate investment trusts, we have institutional investors who buy single-family homes. All of that is driven by platforms that allow trading, not just at the property level, but at the investment level. So I can buy a piece of that for X amount of money. One of my students, they run in Latin America, more of a crypto-focused. Mm-hmm. It's basically a tokenized ownership system, where for as little as $1,000, you can own part of a building. Now, the question is, can they make that a business proposition? Because the cost of acquisition of that $1,000 investor can be high. So I don't think you've seen that component go as far down on the retail investor side, simply because the acquisition cost for relatively small amounts of money is high. But I would say the future is probably there, especially with regard to tokenization, because it just facilitates trading.
And one thing I want to go back to, you mentioned Nick Bloom from Stanford doing,
Right.
Having a major piece of research about working from home. I was speaking with some of the other FIU professors in the finance department, and they said that you're kind of famous for a paper that you published, whether it's better to rent or to buy. And I wonder if you could revisit that study that you did. And
Okay, so we actually have published over a number of years a rent-to-buy
right.
index. And it simply looks at what does it take to rent versus what does it take to buy. And there's some certain assumptions that go into rental. And the proxy is if you are willing to take the differential in cash flow and invest that in, let's say, a mixed portfolio of stocks. I mean, you can do it on various different things. And the question is, for X period of time, which one is better? It's a horse race. Which one would be better? And what we find is that there is variation across most every SMA. But one of the things that really is important is to look at the time dependency, which is what is your expected holding period. And the truth is, the shorter your expected holding period, the more volatility, and the more likely renting is better. So it kind of highlights, in the end, that real estate is a long-lived asset. And if you look at some of the institutional returns where you assume ownership in 30 or 40 or perpetuity, well, perpetuity is not the right, I shouldn't use that for this one, but 20, 30-year holds, over a 20, 30-year period, for real estate, 80 to 90% of the total return is from the cash flow of the property. Okay, so once you put in financing, what is your expected holding period, buy versus rent, you build into more variation. Now, the negative on all the components is, do individual investors or owners have the willingness and the ability to say, I'm saving this money and actually do it? Okay, so one of the contra arguments that we have in even looking at rent versus buy is the idea that sometimes buying real estate to live in is forced savings, which is you have some appreciation and you pay down the loan over time, which is, in a sense, forced savings. And that goes back to the whole idea of behavioral finance, behavioral economics, which is most people don't think that way first, if that makes any sense. I don't sit down there and go, that's a negative NPV. The beauty of real estate is it's relatively straightforward investment. You own a property, it generates a cash flow. It's kind of hard to mask that cash flow. Yeah, and even if you're not an institutional player, there are plenty of platforms now where I can own a single family home and just own it, and the data is available 24 hours a day of all the money, all the cash that comes in and out of the property. We have a couple of firms here in South Florida that have looked at that, which is you buy this, and I can go online, and it's like, okay, I can see. I have 7 tenants in this. Let's say I own a building with 4 people, okay, and it's a limited LLC, and a friend of mine is actually the property manager. Let's say friend. Let's say I have a third-party relationship with someone who does property management, or it could just be my cousin Bob, okay, which is often happening in real estate. But I can see in real time all the cash that runs through that property. Tenant A paid. When did they pay? October the 3rd. That's in the, that's the detail that the technology is allowing us to do through certain of these platforms. And I can just log in and say, well, I don't need to get it. That's real time.
And these are for investors in the REITs?
No, these are investors who are, forget REITs, these are investors just buying a duplex.
Okay.
Okay, so let's say I sell, I convince you that you need to own this duplex, and I go, well, here's the deal. You just sign in here, and you'll see here every cash transaction associated with that property in real time, 24/7. Okay, now we probably need to. Well, I'm not going to. I'll just leave it at that. But maybe we can kind of. But that tech. Okay, I'll just say that technology is not just available for individual investors. It's available for homeowners associations, condominium associations. So we have the technology available now to make everyone aware in real time the status of that investment. Yeah. That is a striking change from 5 years ago or 10 years ago. And when you couple that with any type of blockchain component, the world of real estate becomes much more efficient. And I'm talking about blockchain, not just a conveyance of ownership, but blockchain as related to who has access to data on a continuous basis, more like what you would see in an SEC filing or a REIT vehicle, which is, it's a different standard of reporting, but that could, there are platforms now that allow that, and it just drives down the cost of compliance.
Yeah, and sort of on that note, I know you did also do some research on ETFs and their sort of risk profiles. Like, do these REIT ETFs impact the volatility of the actual of the REITs themselves? Am I
Well,
getting
it's
that
like
right?
it's the tail wagging the dog kind of thing.
But like I know you say that.
But that's
sort of
that's kind of a narrow. I'm going to argue that with the ETF, it's an interesting study, but it's relatively narrow compared to some of the technology, the fintech and the real tech that's coming out there that's going to just provide tremendous transparency for anyone, whether they're the largest institution or whether we're a family real estate business and we have 10 of our and our grandfather started this business with our grandmother, and our grandmother figured out how to do it and make sure that we didn't lose any money. As my grandma would say, if it weren't for me, we never would have made a penny. My grandmother's a very good finance person. But it was like that would be available so everyone could look at it. So when you go to Thanksgiving with your family, no one's going to yell at you because it's right there. And I kind of make a joke of that, but real estate for many people still is a family business. Okay, for all our institutionalization, that's an institutionalization, a lot of finance, but the doing and the managing and the entrepreneurial side is inherently
very personal,
very personal and relatively small. So in South Florida, people talk about related group. They talk about people they know. But related group, how many employees do they have?
Couldn't tell you.
Yeah, you couldn't tell. Well, probably about 400 to 500, okay? Because they work through partnerships and they hire people to, it's a management role. It's not, it's not just them. It's like we're doing this, but we have X company building this tower. Okay, they don't work for us. We hire them. And the reason I bring up related is because everyone knows, and it is a large-scale operator and developer of multifamily across 3 or 4 different platforms, from affordable housing to luxury to whatever. And you're going, eggs, I would have thought a lot more people. Well, there are a lot more people who work and get paid out of what they do than that actually work there. So even the largest players are not huge in real estate when you look at actual I can run a portfolio of billions of dollars with 5 people. Okay, I don't.
The infrastructure's all there.
Yeah, well, if not, I hire, because what do? We have property managers. They don't work for me. That's a contract. We have brokers. We have everybody. So basically, it's a team focus, and people buy specializations. So it's not even the REITs are very fully integrated, especially even the ones that might be the most integrated would be the residential. But even those, they're often just not, why not hire somebody to do X?
It's more cost efficient.
More cost efficient. If they don't do well, you get a new one, and they can specialize in what they do. And so it's the beauty of real estate is that you can control a large asset with a relatively small number of people.
Speaking on, we talked about transparency. We talked about these different incentive systems that help make these decisions and transactions more efficient and effective, create value added. Would you say, and of course the data-driven technology that's really helped make those decisions more effective altogether. Would you say there's like something that you could see down the road and say, let's say next 10, 15, 20 years, that could be the next sort of hurdle, if not U.S. economy, the Florida real estate economy and market might have to anticipate because of just all the things that have been changing?
Well, if I could really see that far in the future, I'd have one of those $100 million houses up in Palm Beach County. Actually, I wouldn't have that. I'm not interested in that. But I could have that. But I think the interesting thing that we have to address in the U.S. is how do we produce sufficient housing stock because everyone should have the opportunity to live in a space that is of a certain level and quality. If I were to go into the business, however, probably the business that people want to go into is the luxury and affluence, maybe not luxury, but the affluent side, because that's where the margins are. That's where there's the ability to charge a premium for premium product. It's not the rote production side. It's, are you efficient at generating and building a certain amount of space? So if I were to look at the future, I would say if we could figure out an ecosystem that allows us to increase supply where it needs to go, we will, as a society, benefit. The difficulty is there are just so many players in the production cycle. We talked a little bit about 2008, 2009, kind of the bust. What people forget during the bust is the people who were in the business, especially of residential development, they either simply went out of business or they went somewhere else or they retired, which is they still had enough where they could pull it off and they were retired. So we lost, I like to say we lost a generation of management entrepreneurs, of people who knew how to do the business.
Yeah.
Okay. And so we're still facing that shortage of people who want to be in the business. So if I were to pose this question to maybe people and say, well, what would you think if your kids grew up to be a home builder? They go, no, I want to be in fintech or a hedge fund or work at Google. And I'm going, yeah, but if there's anything I know is that we're going to have a continuous need, a continuous demand for quality living space. Okay? But it's kind of like, oh, a home builder. Yeah. Well, I grew up, I wanted to be a home builder. Okay? Why is that? Because, it's fun. It's management. It's working hard. It's X. But it's hard work. And to scale that, it's difficult to scale. Okay? So we're teaching people to go into areas where, well, let's just do scale. And what's that? It's like create an app here, and if it takes off, I can have 100,000 users, and then I blow it up, and it becomes something big, and then it crashes down. But luckily, I sold out when it was at its peak. No, I'm just kidding. But what I'm saying is that's, to me, the difficulty is not even the technology. It's creating that willingness. We talk about alternative units. We talk about all sorts of stuff. It's going to take everyone thinking a little bit differently. And we're going to fight the following, which is the real key thing is, if I create more supply, then the values may not go up as fast as they were, okay? Because then there's a different equilibrium point than we have now. Owners of real estate benefit from a shortage in supply, okay? If I go to a developing country, one of the reasons real estate has been a tremendous issue there is the economy grows faster than you can actually build something. So if I go to Central America, and there, in certain years, some of the countries even in Central America are some of the fastest growing countries in the world. Well, if I'm growing my economy in real terms at 8%, and I do that for 5 years, real estate can't catch up. There's no amount. So the wealth and the affluence grows faster than the built environment. So in a lot of the world, that's what we've seen. Now, we've seen that we will see the downside of that in China, because now that they've created more than they need in all but the top tier cities, the rest of the world, it's a catch-up. And even the U.S., it's a catch-up because of what I said about the generation, the lost generation. Not only did you lose the people who were doing it, but you lost everybody who gone, well, I'm not going into that.
Yeah, I could definitely speak to that, because my father, he's a contractor here in South Florida, and 2008, 2009 was very bad for
anyone in the construction.
Anyone in the construction, anyone in the home development, refurbishment, interior design. And all 4 of his sons, myself included, we kind of looked at his plight and we were like, maybe we should think about a different industry to specialize in. But it's definitely something that you could see and take it to the scale of an entire generation at that point. We haven't really recovered from that 2008, 2009, which is probably a challenge.
Well, it's also it's a willingness to take risk.
Yeah.
So my dad was an entrepreneur. Left IBM, started a number of software companies, and as a child, I always would sometimes wonder, why do we, if we go out of town and it's Sunday and we're going back home, why are we going to the post office box? Well, we're going to the post office box because client X had to pay, and we hope they paid because you have to make payroll. Mm-hmm. And most of the software people who bought, at least one of the companies that is most vivid in my mind, they were all large corporations. They paid when they wanted. They were large power companies. They were large retailers. And, they didn't care that you had working capital, that you had 60, 70, 80 employees to pay. So you kind of go, well, maybe I'll go do something else where I don't have to think about it. So I think we see that as families and people make those choices on careers. It's probably a subtle thing, but you go, well, look how hard they're doing. I mean, these people working hard, and what's the payoff? And maybe if I go over here. So people make those choices, even if it's subtle.
Right.
Because I have family members who are staggeringly entrepreneurial. And how did they get it? Well, they weren't in that cycle. They were in the other cycle. They were in the up cycle where everything's going, going great.
They caught the bull, yeah.
Yeah, they're going, oh, yeah, this is great. And then, it's in that cyclicality, if you're an entrepreneur, it's the up cycle, everything's going great. It's kind of the sad when you're going, yeah, and you have to have that mindset to do it. But
the resilience to bounce back. Because the trend is your friend until the end, and then
exactly, that's a good point. In real estate, you always make money until you don't, or real estate, it always goes up until it doesn't. So it's following the trend, and sometimes people have done very well. They just caught the wave. When I first came here, we talked about 2006 and 2007. I was sitting in class. We were starting cohort. And we're going about what everybody did. And I go, well, okay, I have an attorney. I have 2 people who are pharmacists. And I'm going, why are you giving up? I mean, if you want to invest on the side, that's one thing. But why would you give up your career as a pharmacist where there's unlimited job opportunity? You move anywhere. Now you can do stuff on the side. Why are you sitting in this class trying to ride the condo boom? And they were all attracted to it because it was exciting and people were making money. 2 years later, the only people who were in that class were ones who were true believers in real estate as a career. So we attracted a huge number of people who just happened to be there because it was what everybody was doing.
Riding the trend, yeah. Which we saw kind of with the
flipping the contracts.
But also like cryptocurrency during the pandemic. The stocks and bonds with the GameStop,
the meme stocks
and stuff. So, tulips back in the day, I suppose.
Tulips. So, I mean, it's human behavior, and you can do it on a small scale. I talked about one of the faculty who retired. They bought one of the cryptocurrencies and went from 20,000 to 400,000, and you're going, yeah, okay. Then it went down, but they liquidated.
No,
I mean, because at some point they were going, yeah, that's okay, but it really came down to they wanted the money to spend on something else. It wasn't like there was a rational decision. It's like, okay, yeah, I rode this up. Now I can sell it and buy something.
Some real estate.
Or I don't even remember what they bought, but buy a new car. I don't know.
Is there something about our topic, the residential real estate market, that you think is being given an undeservedly minimal amount of attention that you'd like to maybe highlight for our audience?
Okay, when I look at the residential and I see what I'm going to say is the HGTV effect. And what you see a lot of times is simply a subcomponent of what it really takes to be in the business on a long-term basis. So, for example, let's say I can find a property, do a value-add renovation, sell that property. In essence, I'm a mini home builder or a mini developer, okay? The question that people need to recognize is, well, can you do that every 6 months? Or can you do that for the next 3 years? So one of the issues that comes up on the residential side from an entrepreneurial standpoint is that it is labor intensive, okay? And you have to build in an ability to replicate and have a business model. So I talked with a student years ago before I moved here, and the person, because I actually at that time I ran construction management in a real estate program. And what he had built up was, in essence, a construction component that ended up creating a portfolio of investment properties, which is, you know, you're buying a 60s ranch, you update it, you rent it, okay? And that was the business strategy, okay? And the strategy was not to sell it, but to create a portfolio, because then there was a management component associated with that, which created a business enterprise.
Additional income, right?
Additional income, and also you're paid to manage. Someone has to manage real estate. It doesn't manage itself. So you were creating that whole business services model. So sometimes when I talk about entrepreneurs on the residential side, as opposed to systemic things like access to capital, Fannie Mae, Freddie Mac, and those, it comes down to think of it as a business services model, and what does it take to run this as a business long term? Because a piece of real estate, in another sense, it's a cash flow that benefits the investor, but for all those cash flows, there's about 30% of the overall cash flows, or maybe depending on the product, 40% that goes into just running the day-to-day operations of that. It's not all profit, but it's revenue. So then can you build in efficiency? Can you scale that? Can you run that as a consistent? So think of, if I were going to get into the real estate side, I'm going, you know, especially on the entrepreneurial side, is how do I create that business model that I can replicate? I can get lucky.
It would be sustainable. Yeah.
I can get lucky and buy something and make $300,000, but that's not a business model unless I have a strategy to do that every 2 years, or better yet, if I can do it every week.
It has to be sustainable.
Or every day.
Yeah.
You know, so a part of the thing in residential is it sustainable, and then the other component is what is the end result we're going to find related to some of the changes with the National Association of Realtors and having to do with designation as an agent, buyer agent, seller agent, because if you're in the business of real estate, that does impact you, because one of the revenue streams you have is related to the brokerage, the sales and the disposition strategy, because a lot of people are concurrently working that, so I can have an investor that it gets a return, and then I can, in essence, make money by putting the deal together, working it, and selling the property. So all those things are going to probably make it a little bit more challenging in the future, but it also comes down to some people are good at managing the process and doing that, because real estate it's a business. It's not a passive business. It's an active business. So if someone would say, I'm involved in real estate, I go, if you want passive, buy a REIT, buy a fund. But there's a lot of activity you can do if you want to be an active participant. And the question is, how much active participation do you want?
Yeah, instead of just riding the wave, you have like a real foundation that you built.
You can do it, and if you don't do it, what would it cost you to hire someone to do what you're doing? So part of your return may be simply being the service provider to the asset you own.
Yeah, facilitating
that. Well, if I had to hire a property manager or leasing agent or somebody, well, that takes X amount of the cash flow. So what is it my total return, or is it my return to an activity and then a return to an investment? But I think people are attracted to real estate because it's tangential to everything that we do, and it's somewhat tactile in that it's physical. but you really are dependent on the built environment to create a quality of life. And so if you want to have a good quality of life, you start with basically the residential side. You start with X. How do we create those parks? How do we create those interactions? How do we create those neighborhoods that people want to live in? And that's what attracts people to residential real estate.
It's quality of life driven sort of.
Yeah, I mean, and also it can be pretty fun. You know, you're building something, you get to see it. You can trade a lot of assets online, or
there's so many resources to just.
Well, I'm talking about it. If I'm doing real estate, I can come there and I can say, man, now I poured the slab, I did A, B, or C. So there's a component of that people can see, as opposed to I'm sitting in a cubicle and I'm maybe trading millions of dollars a day or hundreds of millions of dollars a day on some financial asset. But at the end of the day, I'm still in my cubicle, and some money goes in my checking account at the end of every 2 weeks and get a bonus. But in real estate, don't ever forget there is a value, and there's something that people inherently like. We helped build that. We helped renovate that. We helped create that environment. And people don't like that. People don't want to hear that because they go, it's financial, it's this, that. No, there's a component like, hey, I built that. Hey, I did that.
It's an easy way to find fulfillment.
Yeah, I mean, it's a way of fulfillment. That's exactly.
I remember one of my childhood memories is seeing how my father took an undeveloped plot of land in the Golden Beach area.
Okay.
And then over the course of years, it was becoming developed, the concrete being poured in, the trees and the bushes being cleared out, and then the foundation, and then the insides and outsides. And before you know it, there's this multi-story mansion that's aside everyone else, and families are able to go inside.
And so I think part of that's the attraction to real estate. There's that physical component to it, and it's visual, and also it's kind of it's still a do business, okay? Doing computer coding and this or that's great, but that's not the same as going back and seeing, well, we built this and now the trees are full scale. Just look at this campus here. Okay, we have a master plan on this campus. We have trees here that are now 40, 50 years old. We have trees that are older that we actually brought here that were 20-year-old trees. There was a plan to create the canopy that we have at FIU that would surprise many people, but there was a plan, and it's a physical quality of life component that people thought about and said, this is a long-lived asset, so we're going to bring this canopy in that you would never expect to find here because it's Miami, it's urban, and it's a relatively new school.
What are these giant African palms doing, all
Right.
over Florida?
So I think that's part of it too. Is you can go back and see what's done. I think we also have a better understanding of how we work in a resilient environment. We have a better understanding for the negative side of development with regard to habitat destruction. I think people are much better than they ever were in the past, and that makes it some exciting stuff too, which in the end, though, comes back down to the same thing as quality of life. What is the quality of life that you want? I've been all over the world. I've been in China numerous times, and it's a fascinating place if you want to look at the built environment. But there's also kind of the beauty of being in a place that has minimal built environment. Like
see the
Shark
juxtaposition,
Valley,
sure.
going out there and checking it out. So so those are things that we have to there are certain trade-offs that we have to make as a society. But when you cut through all that, I'm going to go back and finally just say we need to make sure that everyone has access to sufficient quality housing in this country, and it shouldn't be that hard to figure out. I mean, I'm always amazed at how difficult it seems to be, but I'm going, how much does it really cost to build X? How does it? You know, I have people who work in the affordable housing space. I know people who work all over that space, but for whatever reason, we can't seem to put it together.
Well, that concludes our 4th episode of the Panther Business Briefing and our first on the theme of residential housing in the United States. Tune in next week where we'll explore the history of this exciting topic with Professor Marcus Corbell, who has played a major role in South Florida's banking community and has served as the chairman of the board of directors of the Florida International Bankers Association. Thanks for joining us, and I'll see you again next week.